What's up, trading floor? Monday morning, July 20th. Orange Kitten DFV is chirping at the screen because futures are bleeding and he knows pain is on the menu. Your boy Wildcard, TB locked in beside me. I got a question for the family. And it's the kind of question that breaks the playbook. What does it mean when gold can't rally on a third American combat death? 3 U.S. service members killed in the Iran escalation since Friday. Oil screaming to $90 a barrel. Russia pummeling Kyiv. NATO's military chief warning Moscow about the Baltics. Strait of Hormuz is a red line. Every instinct you've ever learned says gold should be ripping. The war trade. The safe haven. Centuries of buy-in crisis. And gold is flat at 4,026.50. It is not moving on the headline that ought to move it most. TB. Quick disclaimer. Then walk them through the bond market whipsaw that broke that connection. Because I think the real story this morning is the market is more terrified of the Fed than a shooting war.
Standard disclaimer right up top. Nothing we say is financial advice. We're two guys talking markets. Do your own research, manage your risk, you know the deal. And Wildcard is right. The bond market did a full 180 over a weekend with almost no new data. Friday afternoon traders were bailing on Fed hike wagers. Soft wholesale data hit, people started pricing cuts again, bonds rallied hard. That was the close. Then Kevin Warsh talks over the weekend. No new policy. Just the phrase, the inflation fight is not over. By this morning, the Treasury curve repriced completely. We went from maybe the Fed cuts to the inflation fight continues in 72 hours on vibes alone. That's a fragile market. The positioning underneath was already leaning one way, and a single hawkish comment sent it flipping. So now you've got a bond market pricing higher for longer, a dollar strengthening on that story, and gold, priced in dollars and competing with yield, gets crushed despite everything in the Middle East. The mechanism is tight. Oil at 90 feeds inflation expectations. Inflation expectations keep rate hike bets alive. Rate hike bets strengthen the dollar. A stronger dollar destroys gold. The market is looking at 3 dead U.S. service members and saying the Fed story is winning. For now.
That's exactly it. No CPI print, no jobs number, no FOMC statement. Just Warsh reminding everybody the last mile is sticky, and suddenly, the whole narrative flipped. Everyone's leaning on one foot waiting to jump. So if gold can't rally on this, what can? The answer is showing up in hard sector math. We have a 10-point spread between technology and energy last week. The tech sector down 5.48%. The energy sector, ETF, up 4.72%. That's not rotation. That's a regime. Money is fleeing tech and piling into energy, real estate, consumer staples. The stuff that benefits from or is insulated against the oil price spike. TB, you spent the weekend on the semi-charts. Walk us through what SMH is actually telling us, because this is worse than just a tech dip.
SMH has been in a bear market for more than a week. Mike Jones ran the charts. Weekly SMH printed a bearish MACD cross, RSI sitting right at 50. Not oversold yet, which means there's room to fall before any mean reversion buyer steps in. The SOX index, the Philadelphia Semiconductor Index, is even uglier. It broke the neckline of a head and shoulders pattern. Different weighting than SMH, more exposed to Micron and AMD, which have been getting wrecked, less Nvidia, which held up. So the headline masks the damage underneath. And here's the part that accelerates the move beyond what fundamentals justify. KOSPI dropped 4.46% overnight. Nikkei 4.03%. That's not just Asia having a bad Monday. That's the carry trade unwind hitting Korean retail leverage we've tracked since the Rex shares story last year. 20% of Rex shares assets tied to Korea. 65% of Asian ATS venue revenues from Korea. Those collateral pools are getting liquidated mechanically. Margin calls don't read the thesis, they just sell. So part of the semi-sell-off is thesis-driven. Rates higher, artificial intelligence trade cooling, IBM's hammer warning last week. But part of it is forced Korean liquidation that could snap back violently once the forced selling exhausts. The move is scarier than the fundamentals, and the bounce could be just as sharp.
That mechanical versus thesis distinction is what separates our audience from the people who just see KOSPI down 4.5 and panic. When the forced selling stops, the snapback catches the late shorts who piled on after the fact. But the snapback only works if the underlying thesis for semis isn't also breaking. And we'll get clarity on that Wednesday when Tesla and Google report. Now let me pivot to something that's flying under the radar, because it's pizza. Domino's reports pre-market today, and I'm watching it as a real consumer health check, not the pizza. The delivery frequency. If Domino says the working class customer is cutting back delivery orders because gasoline at $4 a gallon is eating into the weekly budget, that's the first hard data point that oil at 90 is hitting Main Street, not just Wall Street. That's way more important than AMC's print today. TV? You wanted to anchor what's on deck. What's the real calendar telling us?
For earnings, there's nothing genuinely notable this week that moves the market on its own. Domino's and AMC today are small. Tomorrow we get Schwab, Danaher, 3M, General Motors, Northrop Grumman, real economy names, but not a market-wide catalyst. The big test is Wednesday, Tesla and Google after hours. If Google flags any ad spend softness from macro uncertainty, the artificial intelligence trade takes another leg down. If Tesla sees demand cracking under higher financing rates, the whole growth narrative gets questioned. But the earnings calendar itself is thin. I'm okay calling it nothing notable.
Good. No manufactured hype. Let's go straight to the economic calendar, because that's where the macro tripwires are. Lay it out.
Tuesday, German PPI, consensus minus 0.2% month over month, prior up 0.3. That's the inflation pulse in the EU's largest economy. Wednesday, UK unemployment rate steady at 4.9%. No change expected, but labor slack matters for Bank of England moves. Thursday is the heavy one. ECB rate decision. Consensus 2.40%, no change. But any hawkish tilt, even a sentence, strengthens the euro, weakens the dollar, and ripples straight into gold and risk assets. Same day we get Eurozone consumer confidence, UK GfK consumer confidence, and Japan CPI. National core CPI consensus 1.6%, up from 1.4 prior. If that prints higher, it fuels Bank of Japan normalization chatter, which tightens global liquidity. Friday, we get a repeat of the ECB decision and confidence data, plus Japan CPI again. Saturday, we get UK retail sales consensus minus 0.1% month over month, prior up 1.2. A miss there is another consumer warning flare.
So the week's macro narrative is ECB, delivering nothing on Thursday, with the market reacting to the tone, Japan. PI nudging the BOJ story higher, and UK retail sales on Saturday doing the same job Domino's does for us today, a demand check. Wow. Got it. Now, sector rotation. This board is screaming. 1 week leaders, the energy sector, ETF, Energy Plus, 4.72%. XLLSL, real estate plus 2.18. XLP, consumer staples plus 1.27. Laggards, XLI, industrials minus 1.38. XLY, consumer discretionary minus 1.54. And the tech sector, technology, minus 5.48. That 10-point spread between energy and tech isn't noise, it's money leaving growth. In cyclicals, and pouring into defensives and energy, the market is pricing a stagflation-light scenario where the Fed stays tight and oil stays elevated. The rotation is accelerating, and it's self-reinforcing. Capital leaves tech to fund energy longs, which pushes energy higher and tech lower, attracting more momentum money to the same trade.
And overnight international flows are reinforcing exactly that. In Asia, Nikkei down 4.03%, Kospi down 4.46%. That's the Korean margin liquidation epicenter we talked about earlier. Hang Seng up 2.36, Shanghai up 0.85. China is detached, trading on its own domestic liquidity. Europe is treading water, DAX up 0.27, FTC down 0.29, Euro Stoxx 50 up 0.23. No conviction there before the US Open. On the foreign exchange plumbing, dollar-yen is flat, euro-dollar flat, the dollar index down just 0.05. Yen stability says no acute carry trade blow-up yet, but the equity carnage in Korea and Japan tells a different story. That mechanical liquidation feeds straight into SMH and US tech through the ATS and REX shares channel, so Asian weakness is a headwind for NASDAQ futures even before the opening bell rings.
And that brings us to the portfolio hot news. The one macro story that has genuine legs this morning, oil at $90, and the energy regime shift. Let's give it real depth. Drivers. First, the Iran escalation. 3 U.S. combat deaths. Strait of Hormuz on red alert, and no diplomatic off-ramp in sight. Second, the Strategic Petroleum Reserve is sitting at 1983 lows. That buffer is gone, which means price discovery is unrestrained when supply fears hit. Third, Reiner's profit warning this morning. Fuel costs are crushing margins, demand softening, stock slid 6%. That's the first corporate casualty of the oil spike. Now, the bull case. Structural supply disruption supports energy equities. My gut book is long. The energy sector ETF up 26 basis points with oil at 90. The thesis is inelastic demand at these levels. Consumers might cut Domino's delivery, but they still fill the tank and take the trip. If Hormuz risk intensifies, oil overshoots and drags the entire energy complex higher. The bear case, Domino's could show a consumer slowdown from gasoline prices, which would be the first confirmation of demand destruction on Main Street. Recession tail risk is real. If the Fed has to double down to fight inflation that oil itself is feeding, demand eventually cracks. And Ryanair's warning could be a leading indicator for third-quarter earnings season across industrials and transports. Second-order effects matter too. China's discounted Russian oil flow deepens the East-West energy cost gap. Chinese manufacturing and EV players get a competitive tailwind that compounds every week this war lasts. TB, your gut book has a tiny BYD position. That's the structural bet on that exact advantage.
Yes, my paper account holds BYD at 87.15. It's a $1,000 position, tiny, but it's a multi-year wager that China's energy cost edge widens. While Western firms absorb $90 crude, Chinese players buy discounted Russian barrels, and that gap shows up in margins over time. On the other side of my book, wave trader Algo is silent. One position, S, underwater about $128. 19 slots open out of 20. No new entries in 3 sessions. The funnel gated out 322 signals on Friday. Good names like CRWD and KLAC on predicted gain thresholds and the exponential moving average momentum filter. The system is basically saying it doesn't trust this environment. Not a lack of ideas, just nothing clearing the full gate set. Cash is a position.
Which is the perfect contrast. My TFT algo is similarly quiet. Just Bank of America and INSEE, both small. Both systems are telling you the same thing without saying a word. Meanwhile, my gut book has one energy trade working because I'm trusting the macro setup, not a systematic filter. That's the week's lesson. Discretionary versus systematic. Both valid, both telling you to stay small. And the energy sector, ETF trade, I'm holding with a stop at 54.30. If oil breaks above 90 and Hormuz heats up, it runs. If not, I get stopped and I'm done. Here's what we're watching tomorrow. 4 concrete markers. 1. West Texas Intermediate crude. Does $90 hold support or does it crack above into a new range? 2. The VIX. Sitting at 18.5, a push through 20 is the risk-off acceleration signal we don't want to ignore. 3. The 10-year Treasury yield. The next leg matters for the dollar-gold dynamic and every rate-sensitive sector. 4. Geopolitical headlines. Any fresh Middle East escalation or diplomatic moves before Wednesday's heavy calendar. Cash is a position. Stay small, stay sharp. Your boy Wildcard. TB beside me. DFV already asleep because he knows we said what needed saying. Trading floor out.